Purchasing an investment property could actually help you counter inflation. There's been a lot of speculation and talk about hyperinflation or inflation in Australia's economy. I don't think we're anywhere near hyperinflation at this point in time, but we have seen a 5 or 6 or 7% increase in average on the average basket of goods here in Australia. So in this video, I'm going to discuss the economic crash we could potentially see in the Australian market and how property might be able to help you hedge against future inflation rises. Now, the reason we're seeing so much inflation, let's rewind 2 to 3 years ago at the start of COVID. When the COVID pandemic hit Australia and hit the world, the central banks started printing a whole lot of money going into our economy. Now we've got all this money and we've had such low interest rates, the demand for goods has significantly increased and the supply can't keep up. Therefore, stores are raising their prices and this has led to inflation. Now the Reserve Bank of Australia is trying to counter inflation by increasing the interest rates within the Australian economy, which will be passed on to the banks, which will be passed on to mum and dads who pay their mortgages, and people will tighten the belt and reduce their spending, which should reel in inflation a little bit. Now, how can property actually help you counter inflation? The way this works is purchasing a property, it's a really good store of value compared to storing cash. Your cash devalues over time as more money is printed, and you're only able to buy less and less goods with it over time. Whereas property is a store of wealth. The parcel of land that you buy your property on, 600 square meters, doesn't reduce with inflation over time. It holds its value and if not increases in value as inflation grows. The same is true for rents. Rents largely follow inflation as costs are passed on from landlords to renters in the property market. So what I expect to see is a lag effect where landlords see increases in their mortgages, then reevaluate their finances and their situation and pass on a reasonable amount to renters. Now, these renters will have to pay increased rents to stay in the same property. As a starting point, let's say that the investor had a 2% interest rate and 5% gross rental yield. So there was a 3% disparity between their rent and the interest expense on the property. Now, interest rates could double and go to say 4% for the investor. And so they might pass that on to the renter. And so the renter would have to pay more rent, which would increase the gross rent to 7%. But the disparity between the interest expense and the gross rent, the difference remains at that same gap of 3%. Now, in an inflationary environment where the Reserve Bank increases interest rates, it ends up being passed on to renters in the end, and investors typically hold a profit gap, 3% for example, to keep the balance in their portfolio. This is just the way Australia's economy works, and a lot of economies across the world operate in terms of using housing as both shelter and traded as a commodity. So if you're looking to purchase a property as an investment, it could be a great counter against inflation because 1, you're going to be able to hedge against inflation through rental rate increases, and 2, it's a great store of wealth. Homeowners are always going to want to keep a roof over their head, and we're very unlikely to see a mass depression where there's a large sell-off of homes due to foreclosures. Obviously, you're going to fight tooth and nail to keep that roof over their head, to keep paying the bills, to keep paying the bank as an owner-occupier. So it's very unlikely that we're going to see that mass exodus out of the property market and see values fall significantly. When you compare this to stock markets and crypto markets, which are highly liquid and they're easy to jump in and out of in a matter of seconds, the property market is far slower in terms of transacting, which also shelters you. It means that the property market can't see massive spikes and dips in a single day. You don't really get a new valuation for your property each and every day. Typically, you revalue your property every, say, 6 or 12 months. What this means is it's hard for the property to see massive declines in a short period of time or massive runs of growth. The property market cycles tend to happen over longer periods of time where we see those booms and increases, then pullbacks, and then booms again. Now, I personally see property investment as a great way to build your wealth and build passive income. I want to be holding assets rather than holding that cash because my assets are going to continue to increase in value over time and the debt will be inflated away. Whereas if I just held cash, it's not going to give me any passive income. It's not working for me and it's going to be reducing in value slowly over time as the cost for products increases. Now, let me know in the comments down below whether you're backing the stocks or the crypto market or whether you're looking to use property investment for your long-term wealth creation. We're in a period of time where there's a lot of speculation around the economy. So I'd be really interested to hear thoughts down below. If you're interested in buying a property in the Brisbane market, I run a Brisbane buyers agency here called Purpose Property. Head over to purposeproperty.com.au. If you could drop a like on this video and subscribe to the channel down below, that'd be awesome. And click this video over here for more things real estate, renovating, and financial freedom. I'll see you in the next one. Peace.